David R. Guttery is the president of Keystone Financial Group in Trussville, Alabama. David Guttery are financial advisors and represent Emeritus Investment Company, LLC. Please stay tuned through the end of the video for additional important disclosure information.
Hello everyone, I'm joined today by David Guttery, president of Keystone Financial Group here in Trussville, to answer a burning question that's on everyone's mind. David, thanks so much for being with us today. You know, does this stock market volatility seem rational to you, and will it ever end?
Yes, it does make sense, and this too shall pass. So I guess we're done here. Indeed, this is the question that I receive most, and it's the topic of discussion that fills most of our meetings with clients. So let's address this in two parts. First, does it make sense? To me, yes it does. But that comes from my understanding of economics. Think of economics as financial physics, the cause and effect relationship, stimulus and response. Last month, we talked at length about inflation and how such was having a huge impact on patterns of consumption behavior. You're looking at a headline from last March that suggested the average consumer would have to budget $5,200 more this year to cover the cost of the same basket of goods and services as last year. Well, I suppose if you earn $500,000 a year, you could do that. But what about the millions of families who earn $50,000 per year? It would be impossible for them to make an extra 10% materialize out of thin air. So get ready to hear the word austerity a lot this year, which is simply the exercise of deciding what will be cut from your budget until further notice. If patterns of consumption are changing, then so should revenue and earnings assumptions for the companies who make the products. Is Company X really worth $200 per share, or in light of weakening sales activity, is it now only worth $150 per share? That's a very high-level example of what's happening in the market. The economics of wages not rising as fast as inflation and the impact such is having on patterns of consumption causes the market to reprice risk, and sometimes quickly.
Well, that makes sense. So David, what about the second part of the question? When will it end?
Well, that's the million-dollar question. Personally, I believe it won't end until enough risk has been priced out of the market to balance valuation against perceived risk. Right now, that is largely a function of the Federal Reserve. Personally, I believe they waited much too long to enter into quantitative tightening. They told us for too long that inflation was transient, and indeed it has proven to be stubbornly persistent and pervasive. So the Fed is having to play catch-up in an effort to quell the inflation being caused, in large part, by the precedent-setting amount of money that they've printed over the last 2 years. Rather than a gradual, modest approach to tightening, the Federal Reserve continued to print money and add to its balance sheet through February of this year. To me, that's akin to sprinkling gasoline on a fire and believing it would help to extinguish the blaze because it's wet. The Fed is having to be much more active in terms of policy and unwinding its balance sheet, and the market is pricing into itself the odds that such might hasten or worsen a recession.
Well, David, what are your thoughts on the likelihood of being in a recession anytime soon? Do you think the market may be overly pricing that risk into itself at the present time?
Within previous videos and other commentary posted to our website, I have suggested for nearly a year that we could find ourselves in a recession by 2022. Most media outlets continue to suggest that such is a greater risk next year. Frankly, I think we're in the beginning stages of a recession now. We have already seen the first negative read on Q1 GDP, and today we got a second read which was even worse than the first. I don't see anything on the horizon that could change that outcome. Furthermore, I don't anticipate anything changing in time for Q2 to reflect a positive GDP outcome either. If the definition of a recession is 2 consecutive negative quarters of GDP output, then we may already be in the recession. The question from here is for how long and how deep, and that is anyone's guess. I know that confident consumers spend money. According to the most recent University of Michigan Consumer Sentiment Survey, we have the third lowest confidence reading since the Great Recession. I know that headline inflation remains stubbornly high at 8.3% year over year as of April, and those forces don't seem to be abating. I know that over the same period of time, non-farm payrolls grew by 5.6% on a gross basis. So net after tax, if the average consumer kept 4.7% of that increase, while inflation rose by 8.3%, then for a fifth consecutive rolling 12-month period of time, our capacity to consume has declined. We know that not everything we consume went up by 8.3%. Some economically inelastic things like gasoline have risen at a much faster pace. And due in part to supply chain disruption caused by the war in Ukraine and other logistical impediments, the much higher cost of fertilizer has hit grain growers across the world very hard. And now we're anticipating significantly higher costs of food over the balance of the year as well. Meanwhile, according to the Federal Reserve, the average household use of consumer credit is higher today than at any point over the last 20 years, including the Great Recession. So connecting these and many other economic dots, you really aren't left with an optimistic view of the potential for growth. I believe that we're in a recession already. What makes it worse is that the Fed is doing things that are normally seen at times when the economy is expanding too rapidly. And the intent is to disincentivize borrowing. Well, companies are much more focused on being lean and efficient now, not bigger. The economy is contracting, not expanding. So the worry is that while the Fed tries to rein in that which they spent 2 years creating, they could be doing it at a very bad time when the economy is contracting anyway. And a mild recession could become a bad recession, exacerbated by the Fed. So yes, this market volatility does make sense to me from the perspective of economic financial physics.
So David, how does the average person out there investing in their 401k navigate a period of time like this?
Well, the worst thing you could do is quit. First, people must be mindful of goals that are 10 years or longer into the future. Second, the 401k or the IRA or the investment account should be driven by an overarching plan. If not, then you're really just throwing money into an investment platform with absolutely no idea of what to expect from it in the future. In that case, the minute-by-minute market volatility will keep you up at night. Now, as I said in last month's video, successful long-term investment management is planning first, execution second, and without exception. Execution is important, but not more important than the plan that governs the account. Fourth, pay attention to what you own. Do not take an autopilot approach with the investment of your accounts. There are times to own stocks of growth and discretionary companies, and there are times when it's best to own stocks of companies that make economically durable products that you're going to consume regardless of the state of the economy. Look for companies that are trading with attractive ratios of forward PE and discounts to fair value that pay attractive dividends. That's the defensive way to survive in this environment. Pay attention to the fixed income portion of your portfolio as well, because with the Fed in quantitative tightening mode and with 2 inverted yield curves, you might really want to curtail long-term exposure to debt instruments that are suffering from significant price distortion. Again, this is high-level stuff, but this is what we do with our clients, and your viewers should engage with their financial professionals proactively to do the same thing. Remember, this is a marathon, not a sprint.
Well, David, great advice. Thank you so much, as always, for being with us. For additional information, David may be reached through the means listed upon the following screen. For the Trustful Tribune, I'm Brandon Dawkins.
David Guttery independently offers securities and investment advisory services through Emeritus Investment Company, LLC, member FINRA, SIPC, and Emeritus Advisory Services. Information provided in today's segment is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed and should not be interpreted as tax or legal advice. Any performance stated is past performance and is not indicative of future results.